Moving to the financial and operational performance, the key highlights and developments for the fourth quarter and full year 1920 are as follows. For the fourth quarter of 2020, consolidated total income was rupees 1,509 crore, registering a growth of 7.5%. Consolidated profit before taxes, excluding non-recurring and exceptional items, was 18 crore compared to 54 crore in the previous year. Similarly, for the full year of 2020, consolidated total income was 6,876 crore, registering a growth of 15.7%. Profit before taxes, excluding non-recurring and exceptional items, was 281 crore compared to 361 crore in the previous year. Above financials are adjusted for non-recurring items, the details of which are as follows. In the fourth quarter and the financial year 1920, total income excludes rupees 134.7 crore and profit before tax excludes 78.1 crore of income earned from sale of real estate projects. The financial year 18-19 has been adjusted for two non-recurring items. Firstly, the fourth quarter and full year fiscal year 19 excluded a loss of 2.3 crore incurred on sale of land in a subsidiary CDPL. Secondly, the full year financials also exclude income of 29.9 crore earned on sale of land in GAVL. Please also note that the financials for fourth quarter fiscal year 20 and fiscal year 20 include the results of Godrej Foods Limited and Godrej Maximic Private Limited, which became subsidiaries with effect from March 27, 2019. Now I will discuss the performance of each of our business segments. In the animal feed business, volume declined in the fourth quarter by 11.3%, mainly due to lower poultry feed volumes in February and March 2020. Volumes were also affected in cattle and fish feed from mid-March onwards. As a result, despite taking price hikes, volume declines high raw material costs lowered the quarterly segment results by 27.9%. However, the full year 2019 to 20, segment revenue and segment results have posted a growth of 20.1% and 19.6% respectively, driven by the strong performance of the first 9 months. We are seeing a recovery in poultry prices from April onwards as the COVID-19 linked rumors are fading away. We expect volumes and profits in the first half of the year. In the crop protection standalone business, the sales mix was in favor of traded products, which have relatively lesser margins. Therefore, despite revenue growth, the segment results declined in the current quarter, albeit on a low base. Further, replacement of products happened in March 2020 due to the lockdown, which impacted sales and margins. For the full year 2019-20, the performance was modest due to erratic and subsequently delayed monsoon, which limited application opportunities. During the year, the company successfully launched Liquid Max, which is an in-house cotton herbicide, and Hanabi, which is a specialist to control mites on tea plantations. Going forward, these products should help increase revenues and profitability. In our subsidiary Aztec Life Sciences, it was one of the best quarterly performances as revenue and EBITDA grew by 35% and 66% respectively. Higher realization, along with volume growth in key products, contributed to this growth. For the full year also, revenue and EBITDA, excluding the non-recurring expenditure of rupees 6.2 crore, grew by 21% and 18% respectively. Geographically, both domestic sales and exports contributed to our growth. Streamline Dairy Products Limited, our dairy subsidiary, posted marginal revenue growth of 5% during the quarter. This was because milk sales were lower than last year and volumes of value-added products were also impacted by the COVID-19 disruption in mid-March. However, for the full year, value-added products have grown at a faster pace than overall growth. As a result, their share has increased to 29% of sales from 24% 2 years ago. Profitability for the quarter and for the year was impacted by high milk procurement prices. While we have taken price hikes at regular intervals, the entire cost increase could not be passed on to the customer due to time lags. In terms of new launches, we have launched Jersey Recharge, an energy drink for the youth, which has been well received by the targeted customer segment. In the medium term, our focus remains on increasing the share of higher margin value-added products in the overall product portfolio. Godrej Agrovet Limited, our poultry business, witnessed one of the most difficult quarters as output prices in the live bird business declined to unprecedented low levels due to rumors linked to COVID-19. We incurred a quarterly loss of 33.5 crores at the operating level. For the year, the loss is at 47.6 crores. As performance in the first 9 months were also impacted by high raw material prices. However, I would like to highlight that the market has started improving with prices of live bird increasing. Further, raw materials have started softening, which should lead to improvement in performance in the near term. India's joint venture in Bangladesh, ACI Godrej, recorded a robust revenue growth of 83.3% in fourth quarter fiscal year 20, driven by strong volume growth in cattle, broiler, and aquafeed. I now conclude our business and financial performance update for the quarter. I will take this opportunity to highlight that in these challenging times, we at Godrej Agrovet are fully committed to support our nation, customers, business partners, and employees. We are well equipped to manage the current situation based on the strong business continuity plan put in place. We are also focusing on cost optimization and working capital management. Our balance sheet remains strong with low gearing levels of 0.3 debt to equity and healthy liquidity position. With this, I close my opening remarks. We will be now happy to take your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the questions queue assembles. The first question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Hi sir, good afternoon and thanks for the opportunity. My first question is on Tyson Food and the poultry business overall. While you did mention that, things have stabilized as prices have sort of, normalized now versus what we have in the last quarter. But your sense and, your thoughts on how do you see both Tyson Food as well as the poultry feed business, panning out in the next financial year?
Okay. So let me just brief you that normally India places about 75 million to 80 million broilers a week, and it produces about 220 crore eggs a week. And you'll be really surprised that in month of April, according to our calculations, the production has come down to 35 to 40 million a week, which is less than 50%. And the egg production has come down to about 170 crores to 180 crores per week. One of the problems right now in the industry is that the demand is still subdued, but the supply is matching the demand in both eggs as well as chicken. So that is why the prices have gone up to about 95 to 100 rupees in different parts of the country. And in southern part of the country, it has already crossed 104, 105 rupees a kilo ex-farm. Cost of production, which was about 84, 85 rupees in March, has substantially dropped to about 77, 78 rupees now and dropping, because raw material prices have come down, majorly because of low demand for raw material as poultry feed demand has come down. And second reason is that the maize production of Rabi is come into harvesting. So this year the crop is bumper, mainly in eastern India. And to give you an idea, which will play out in next few months in cost of poultry feed as well as cost of chicken and egg. In different parts of the country in January, the price of corn was 22 to 24 rupees a kilo. Today it is holding at 12 to 14 rupees a kilo and falling. So we believe that next few months the prices will be remunerative. Low demand will also be met by low supplies, because in poultry we cannot up the supplies at very short notice. Heavy losses have been made, particularly in the chicken industry, to the tune of something between 12 to 15,000 crores by all the players. You won't believe in March the average price in some markets was 4-5 rupees a kilo, when the cost of production was about 84 rupees a kilo ex-farm. So we believe that this is likely to happen in the next few months. The prices will be remunerative. 50% of chicken demand is out of home consumption. In case that comes back in next few weeks to the tune of 15-20% of the original level also, we will see shortages of chicken and the prices going up, coupled with raw material prices down. I think the profitability will improve in this segment. Another thing which we are seeing is surge in value-added products, heat and eat products, ready-to-cook products, etc. There is a big surge in demand in spite of very poor distribution still. The reason is that since out of home consumption has gone down, so people are experimenting and having ready-to-eat products at home just to replicate that. And we strongly believe that home delivery models, heat and eat models, which gain a lot of momentum towards out-of-home consumption, will still take time to come back. As far as poultry feed is concerned, yes, definitely. Our major part in poultry feed, we sell close to about 5.5 lakh tons of poultry feed. Out of that, about 4 lakh tons of so is layer feed, where we don't see any drop in the coming year, because egg is a steady business. Whatever cut in production was there will come back in a few weeks' time, because the placement continues. Broiler feed was a smaller segment for us. We strongly feel that we will have about 10 to 15% drop in broiler sales, broiler feed sales in this quarter as compared to the last quarter. The reason being that even though the placement has come down, the players have also reduced in this market. We can sell as much as we want. The one problem is that there is a shortage of cash, so a lot of credit sales is happening for a lot of players, and which we are not encouraging. So in all, I feel that both cattle, poultry likely to do well in coming months. In case there is a small pickup in out-of-home consumption demand in chicken prices will also be at a very profitable level.
Sure, that's helpful. So, sir, on the animal feed business, while we have, barring this quarter, we have seen, the last maybe 7, 8, 9 quarters, wherein we had showed a strong volume growth, more or less, in tandem with the guidance, of around 10-12% odd volume growth. Do you think FY21 can see, that sort of a volume growth rebound again, especially when, the rest of the industry, as you rightly mentioned, is reeling under pressure, and there could be consolidation-led, benefits to us there?
So, consolidation I do not know, because not too many assets come up for sale in this industry. You've seen in past that people exit and come back because entry-exit barriers are very low. But I can definitely say that first and foremost, the prices of output have to be at remunerative level, which are at the moment, especially in aqua. Both shrimp and fish prices are very remunerative. Egg and chicken prices are getting remunerative and will continue to be remunerative for some time, because if the consumption goes up 20-30% more than what it is now, there will be shortages. Cattle feed still is a little bit low because the milk prices have not gone up. Substantial part of milk production is consumed in the institutional sector. All these chai, coffee shops, long shelf life products, ice creams, etc., which where in spite of being the season, normally summer is the season for these products, but the demand has not picked up. Once it picked up, definitely we see in a reduced market also we see our market share going up as far as animal feed is concerned.
Sure. Sir, my last question on the crop protection business, both on standalone and on Aztec. Standalone, why the margin sort of, corrected sharply for us in the quarter as well as for the year, and your thoughts there? And on Aztec, what has been driving the growth and the outlook ahead? Thank you.
I'll answer the crop protection business question, and my colleague, Mr. Arijit, will answer the Aztec question. So in crop protection business, we are on an overdrive as far as collections and hygiene of the business is concerned. And it so happened that we picked up a lot of material from the market, which was reversed in sales in the first half of March. Normally in the second half of March, just because the credit periods are very strict for distributor pick up the material towards end of the month, and there is certain amount of advance booking, particularly in products like Rhizostar, Hitweed and Hitweed Max, which had happened, and there were substantial orders we had, but we could not dispatch, and everything was shut from 22nd of March. I think that hurt us in the margins. We could do that in April, but definitely the game is on. Most of our production facilities came into production towards first half of April. It was not classified essential initially, just like feed and milk and others. They came into production the first week of April. But we believe that we will recover the lost ground in coming weeks. Aztec, please answer.
Yes. So Aztec, we have to think of the business like two parts. Where the generic businesses, where it is enterprise businesses, in the fourth quarter, we had both advantages of one. Internally across the globe, there was a disruption from Chinese supply side. Because the Chinese problem with COVID started during December, which aggravated by middle of January, which coincided with the new year. So that was the advantage which came to us. Hello?
Yeah.
Go ahead.
So that was one of the advantages because we repositioned ourselves. Major purchases shifted from China to us. So we captured a lot of Southeast Asian markets. Russia CIS market opened up very strongly. That has been one of the growth, and that will be a permanent growth. Plus the US-Europe market. So these changes will be to some extent permanent because most of the multinationals will now actively looking for de-risking. So these one change in terms of enterprises will be there. Second changes which will happen is, or which we are also experiencing, is shifted to the CMO businesses, because if you see most of the multinationals are working in asset scale. So they do not produce much actives within themselves. They just procure it either from China or India. The majority, almost 75% is working from Chinese only. So there is a shift. So almost this year, we have launched 2 new products. So that is actually a shift from China because they used to procure from China and it has shifted to India to Aztec. So these two changes will more or less remain permanent. You will see more of Japanese projects coming to Aztec as well as to other companies. And enterprise businesses de-risking will go on. So for coming year also, we think this type of growth we will be able to maintain.
Sure. That's helpful. Enterprise business.
I'm so sorry to interrupt, Mr. Padawan. May I request you to rejoin the queue, sir, for follow-up questions? Thank you. The next question is from the line of Kapil Popat from Sundaram Mutual. Please go ahead.
Thanks for the opportunity, sir. I have 2 questions. One is you have talked in your presentation about the expenditure control measures, and you have also talked that the liquidity is very good. So if you could elaborate on both these points, it would be very helpful for us.
So, as far as fixed cost and variable cost control, there are several measures which have been implemented by us. First and foremost is that we have program recruitment that we did probably in February, and there is a big focus on productivity improvement. The second is that just because of COVID, there is a benefit of very little travel, which used to be a very big cost for us because we had almost 700 people and 250 managers, etc. traveling. So I think that cost has come down. On the variable and all the other costs have been curtailed, particularly no conferences, and we have also not given the annual increments also in the first quarter, and we will review the situation towards the end of first quarter where we are and what is the COVID situation and how the impact of COVID on business is playing out. Having said that, in the variable cost, definitely we have curtailed sales promotion expenses, discounts and commissions substantially. One of the reasons is that even production is a premium right now. So whatever is produced is sold, so there is no need for push kind of promotion expenditures. Apart from that, we are keeping a very strong control on credit right now. One of the problems we had, particularly in aqua feed business and our crop protection business, has been bad debt, and I think this is something which we are controlling. Some amount of recoveries have also happened in first few months of this year, including April, and that we should try and continue in time to come. So I think if you really ask me, the most important two things in this year would be, first one will be on cash. I think we just don't want to increase our debt. We want to recover the money, and we want to be very low on loans. And second thing is that we just want to clamp down on both fixed and variable costs. I think it is also giving us an opportunity to also realize what all can be given up even in good times, because I think for all companies, for everybody, these 45 days have been eye-openers.
Right. And also about the liquidity part, how are you managing the liquidity front?
I think had COVID not happened, we were sailing very well, and we would have, our debt would have been very, very low, but unfortunately our collections really suffered towards the end of March. You know, everybody pays between 20th and 30th of the month. And so debt is still at about 0.23% or 0.25% of the equity, so which is a good level. This is a season also, so naturally some debt will go up, but we are fixing our collection system. And in some businesses we are seeing that if the output prices improve in coming weeks, the collection will improve substantially.
Right, sir. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants, we would request you to please restrict your questions to 2 at a time. Should you have a follow-up question, we would request you to rejoin the queue. Thank you. The next question is from the line of Sunil Kumar from Motilal Oswal. Please go ahead.
Yeah, hi sir. So my question is regarding palm oil business. So what is the utilization of the plant currently, and how is the availability of FFB?
So palm oil business, very predictable business. If you know the age of our plantation and the standards of production at a particular age, we will be able to predict our FFB production. The only variable is normally the weather, that particularly monsoon. In case the monsoon is good, then we don't see any problem. Our season normally is July, August, September and October, where we receive almost 55 to 60% of the fruits. But the initial arrival trends are good. We are running one of our mills which can do 1200 tons per day right now. In another week, we will start the other mill which will do 1200 tons. We are also refurbishing another mill which will have a capacity of 600 tons per day. The reason is that our peak last year our peak was close to about 2,400 to 2,500 tons per day. This year our peak for about 2-3 weeks is likely to be more than that. That is why we need 3 plants functioning. So you can say that normally the capacity of these plants is calculated on 6 monthly basis, because almost 5 months these plants are operated once a week or so. So if today we have a capacity of close to about 4 lakh tons, about 2,000, let me tell you in this thing, 3,000 tons per annum at peak capacity. And today we are operating at about 1,200 tons per day. So 3,000 tons per day. At peak capacity, we are operating at 1,200 tons per day.
Okay. So there is no impact of the COVID-19 on the utilization side?
The issue is that I'll tell you the impact of COVID-19. The fruits will come, they have to be harvested, they will be brought, there will be oil in the fruits, depending on whether the fruits will be more or less and the oil will be more or less. The only problem is because of COVID, now the prices of both crude palm oil and palm kernel oil have started coming down. The reason is palm kernel oil import is close to 9 million tons, and most of the crude palm oil, is consumed by the institutional players. All these bakeries, confectionaries, eateries, etc., they consume huge quantities of palm oil. And most of the domestic consumption in India is soft oil, which is your rice bran oil, sunflower oil, cottonseed oil, groundnut oil, soya oil, etc. So we strongly believe that in case the out-of-home consumption or the institutional consumption remains subdued, palm oil prices are not likely to rise, and maybe in case they fall too much, the government will bring in more duties. As far as palm kernel oil is concerned, palm kernel oil is an industrial oil which is used in FMCG sector and some beauty products, etc. So once those factories start and that consumption rises, palm kernel oil consumption will also rise. So our sense is that there will be no effect of COVID on production, on yield, on OER, etc. The only effect will be on the prices in case the consumption doesn't go up.
What is the price now currently?
59,000 rupees a ton.
The similar level of previous year?
No, previous year was a little less.
Okay.
But if you take for example March prices have gone to 68,000 rupees a ton also.
Previous year?
About 4 or 5 weeks ago, 6 weeks ago.
Okay. And how is the utilization of crop protection plant?
Crop protection plant, we have permission to run 2 shifts only, because there is a staggered opening of the industrial activity in different states. First, they gave us permission for 2 weeks. For 2 weeks, we ran about 8-hour shifts and maintained all protocol and procedures which they were checked. And based on that performance, we got permission for another shift, and we hope that from 17th onwards we will be able to run 3 shifts regularly.
So currently it is at 50% utilization, right?
No, still not 50. You can say that just because we are not taking weekly offs, etc., we can run the plant on weekly off by giving OT, etc. in these times. So we will be operating at about 70%, 65 to 70%.
So then we will not have the loss for the industry and for you?
No, my dear. These plants should have run 100% capacity from 5th March onwards, 15th March onwards. So whatever is lost, I hope we are able to make it by running it on weekly offs, etc., and improving productivity. So the industry has lost almost 1 month of production,
Thank you. I would request Mr. Kumar to rejoin the queue for follow-up questions. Ladies and gentlemen, please limit your question to 2 at a time as we have several others waiting for their turn. Thank you. The next question is from the line of Madhav Madhav from Fidelity Investment. Please go ahead.
Hi, sir. Good evening. Thank you so much for your time. Just wanted to understand on the crop protection business, I think there was the idea of reducing our debtor days in FY21. Given the COVID impact now, the unexpected impact, can we push that plan ahead by some time, or will we still be looking to cut down working capital days in the coming year in the domestic business?
Yeah, so man proposes, God disposes. So I think but my answer is anybody's guess. We will try and to balance risk with business. So I think that the kind of discipline we wanted to bring in collections and inventory management will be relaxed for some time, at least during season, and we will see how we can tighten it. Try and balance that whatever is possible. I think this year is not the year of value growth, etc., and sell all kinds of generics. This year we will focus on profitability, on collections, etc., and we have the products which we are sure that if the season is good, can give us good collection and larger volumes also.
Got it. And the palm oil business last year, we also had the pricing pressure. What were the levels of the palm oil prices in Q1 of last year, same time, when the margins had faced some pressure?
Q1 of last year, I think, if I correctly remember, the CPO prices were at 54,000 rupees a ton, and palm kernel oil prices were 66,000 rupees a ton. Unfortunately, palm kernel prices had dropped to 60,000 and even below 60,000 because of lack of demand. And this year also palm kernel prices are very low. Normally there used to be a difference of 50-60% between CPO and CPKO prices, but not anymore. Let us see if the FMCG sector opens particularly the personal products, etc. In coming weeks, palm kernel oil prices will go up substantially. That is what our expectation is.
Understood. Okay, thank you so much, sir. Thank you.
Thank you. The next question is from the line of Pratik Ramnekar from Credit Suisse. Please go ahead. Sorry, we seem to have lost his line, so we'll move to the next question, which is from the line of Kishore Tijara from Axis Capital. Please go ahead.
Yeah, hi, good afternoon to all of you. I had a couple of questions. First is regarding the Godrej Tyson business. Just a broader question would be that are we the rightful owners of this category, of this business over time? And given the fragmented and commoditized nature of the segment, do you think over time there is a sizable profit opportunity for us? And what could those broad strategy or thought process be from your side?
So let me just break that business into 2 parts. One is the branded business, which is the real good chicken and yummies. And the other is the live business, which is a commodity business. Let me also tell you that this industry has grown at a CAGR of about 7-8% volume for the last 20 years in India. And in spite of COVID, in spite of all the ups and downs which will come in this industry, in 7-8 years the chicken consumption will again double in this country, because this is a protein which is acceptable to most of the Indians, because India is not going to be a beef country or a swine country. It will have to be chicken, egg and milk, which will be the chief sources of animal protein. Now, the only problem in this industry is that the processing or the branded business are 1-2% of the total size of the industry, which is close to 70,000-80,000 crores, and the branded chicken business will be about 2,000-3,000 crores, and we are the large player in that segment. But it is still not big, it is still not growing, because of several reasons. That is, one of the reasons is adoption by the consumers, whether it's cold chain, etc., etc. So it is tricky. Two drivers of these businesses, which we have studied, countries like ours, which exploded in these areas about 15-20 years ago. The drivers were rise of modern retail and food laws. Both are not happening at the pace with which they should happen in a country as populated and as congested as us. So I think this is a drawback which is there. Of course, there are plenty of times that things improve because of certain events like China after the bird flu banned street processing or street slaughter of chicken, and suddenly there was a plethora of chicken processing plants at the investment of thousands of crores which came up in China post bird flu in 2003-2004, and from 10% processing in 10 years, China has become 90% processing industry. So that's unlikely to happen, but if this event can increase the pace of growth of this segment because of want of hygienic chicken and because of the growth of business models like direct to home and licious, etc., where chicken is delivered and you need not go to the shop to buy it. We believe that I think it is still the yummy or real good chicken will have some kind of traction in time to come. On the live business, let me also tell you that we have data for last 15 years. But for these events like bird flu or COVID, we have always seen that patches of undersupply and patches of oversupply keep the prices balanced. We have to be on the lesser side of the cost curve, and we have seen people exiting the industry. 10 players at one time controlled 10% of the industry 20 years ago. Now they control 60% of the industry. They become bigger. So I'm saying that there is an opportunity. However, it is a matter of choice, strategy, where we want to be, and I think we would still watch before making our next move on this.
Sure. Okay. And second question would be regarding the agri imports. While you did discuss it earlier, but I recollect, we have a pipeline of in-licensing molecules that we were supposed to get from R&D majors. What is some of the progress on some of those initiatives which can ensure longer-term sustainability of growth?
So I think whatever we could launch, we launched. You know that in December we launched Hanabi. It is a Nissan product for mighty-side in tea and chilies. Response is excellent. Whatever material we got, almost all of it is sold and results are very good. Most of the other products are at different stages of registration, and I think this temporary disruption by COVID does not change a long-term story. Of course, last year and this year we were banking very high on Orizo Star and Hitweed Max. Both these products Hitweed Max sold to our expectation. We produced about 160 KL, we sold 160 KL, but we also sold Hitweed normal of about more than 320, 330 KL. And this was the current year we were looking at reversing the whole thing because we want to push Hitweed Max. The results are very good. It is a herbicide which takes care of both types of weeds. So I think that story will continue, and I think we had outlined, I don't have that paper with me right now, that there are 3-4 molecules which are under registration which will be launched in 2021 and 22 and 23. I think that is on track.
Sure. Okay, thank you and all the best.
Thank you. The next question is from the line of Satish Rangnekar from Credit Suisse. Please go ahead.
Yeah. Hi, sir. Good evening. Thanks for the opportunity. My first question is on the crop protection segment, sir. If you could just throw some light on what are the external challenges that you notice in the coming 6 months from the farmer end. So it could be either labor availability or liquidity or just progress of sowing. If you could throw some light on that.
Well, let me just surprise you on a few things. Fertilizer sale is more than last year. sowing and procurement is more than last year in spite of all this. I think the state government and the central government really did a marvelous job as far as the agriculture sector is concerned. 2 installments of payments have already been transferred and RFPs have that payment, and slowly this will reach the farmers also. The seed sale is very brisk, be it paddy, be it corn and be it cotton. And my news is that several states have started sowing paddy also, particularly the nursery paddy. Because the nursery is transplanted after 3-4 weeks into the main field, which will happen post 15th of June, 1st to 15th of June. So for that, nursery preparation and sowing has already happened. Large parts of northern India are also thinking of dry sown rice, which is called DSR, which means that because of labor shortage, they cannot muster enough labor to do transplanting, so they are going in for direct sowing, which is also good news for herbicide companies, because whenever we have direct sowing, the chances of herbicide usage are very high. So I think that there are 2 showstoppers in this segment right now. One is monsoon, which is a no-brainer, and the second is that if you see, all agrochemical factories are located in certain pockets in this country, which is Gujarat, Maharashtra, and to get excise benefits, we are located. A lot of companies are located in Jammu also. Now, depending on COVID situation, containment, red zone, lockdown starting, lockdown opening, cases, because there are so many variables at play as far as industry is concerned, and there is no consistent policy being adopted month on month. Everything is so dynamic, depending on the situation of COVID, that it is changing. Whether they will quarantine the factory for 1 week or 3 weeks or 2 weeks, that clarity is not there in different states. So I think if the industry is able to produce continuously and at full capacity, number one. Number two, if this is the first time we are hoping that monsoon is late by a week or 10 days, so we get 10 more days of production and we will cover up a lot of lost ground there. If these 2 things continue, good production and good monsoon, I don't think we are going to have a bad season. Liquidity should not be a problem. And I need not recount these Kisan credit cards and direct benefit transfer, etc., which is going to happen. Procurement has been much higher than last year. Now the procurement of pulses and oilseed has started. So I think government will put enough money in the agri space.
Got it. On the feed segment, so do you think prices this year will be lower because of the lower corn prices or lower maize? And in that case, we can be able to...
we always set our profit margins and contribution margin on rupees per ton. So according to the top line is vanity in feed business.
Right. So then in that case, we should be able to maintain our profitability on a per ton basis.
I'm saying that the way things are going and the way we believe, you may compliment us for higher percentage of profit on sale, because sale price will come down because the raw material prices come down, and the margin will expand because some price reduction we will keep.
Fair enough. Thank you, sir. That's all from my side.